Corporate Finance Presentation. Poison Pills. Get ready, it's time to take our chance with corporate finance. A poison pill can be a defensive tactic utilized by a target company to prevent or discourage hostile takeover attempts. So in other words, if one company fears that they are vulnerable to a hostile takeover attempt by another, possibly through the purchasing of a majority share of the stock, they may put provisions in place to make it more difficult or painful for an acquiring company, a hostile takeover to take place, those then being the poison pill. So the poison pill allows existing stockholders the right to purchase additional shares at a discount, effectively diluting the ownership interest of the new hostile party. So that's going to be the general concept of the poison pill. There might be different kind of ways that these different poison pill strategies can take place. They can evolve over time and use different strategies. But the most common type of strategy would be that you give out the discounted rate of the stocks that would be issued to the existing stockholders, not to the hostile takeover company, which could be triggered by some event such as the hostile takeover in company hitting a threshold of the percentage ownership, and by selling more stocks to everybody other than the hostile takeover individual, it would be more difficult for them to achieve the goal or objective of a certain percentage, such as a majority percentage in that way. So types of poison pills would include the flip-in, which is probably more the classical kind of type that we would think about. Again, these strategies, these defensive strategies, can evolve over time as circumstances change. You can get more complex type of strategies going in over time. You could see that these strategies, as you put them in place, can be something that you wouldn't really like to see them, because you could see that they will, be costly in the future and put undue kind of red tape in the process. But of course, the goal here is to stop or make it less appealing for a hostile takeover attempt to be involved here. So a flip-in involves allowing the stockholders, except the acquirer, to purchase additional shares at a discount. So this right to purchase is given to the stockholders before the takeover is finalized, and is often triggered when the acquirer gets a certain threshold percent of shares in the target. So we have this automatic thing that's going to trigger once an acquirer, the hostile takeover, the hostile party, gets to a certain percent, in which there's a discounted offer to the existing stockholders, which if they take advantage of and they were able to issue more stocks out into the market, then that would result in a dilution for the people that didn't get the discount, the hostile takeover, and for them to acquire the percentage they would need to complete the hostile takeover, it would be more difficult and costly for them to do so. Then there's a flip over, a little bit different, allows the stockholders of the target company to purchase the shares of the acquiring company at a big discount if the hostile takeover attempt is successful. So it's got that kind of provision involved. So for example, a target company stockholder may get the right to buy the stock of its acquirer at a 2-for-1 rate, resulting in the diluting the equity in the acquiring company. So that can cause, again, pain to the acquiring company. So the poison pill disadvantages. Obviously, the advantage of the poison pill from the perspective of the company, and especially if you're in management, you're saying, hey, look, we don't want a hostile takeover, because what happened last time they took over, this hostile takeover happened, everybody was fired, right? The first thing they do, that's from Secret of My Success, by the way, as a 80s movie, Michael J. Fox. Anyway, when there's a hostile takeover, oftentimes what the goal is to take over the company and replace management, often with the idea that if you had a more efficient management or took some other strategy, that you can increase profits for it. So clearly, the people that are currently there are going to want to not have the poison pill take over, not have the company be hostilely taken over. And of course, the poison pill could be an option in order to do that. But you can see that now that we put these automatic triggers that are going to happen, we're doing things that are kind of artificial, adding red tape, and that could cause us to start doing our operations in such a way that might not be as efficient or natural. And so obviously that can cause problems as well. So there are disadvantages to the poison pill too. So the stock value becomes diluted. So shareholders often have to purchase new shares just to keep even. So clearly, if the situation is that if the poison pill was actually triggered, right, one party, the hostile takeover got to the certain point, and now the shares are being issued to the existing stockholders so that they can purchase more shares. Well, they're going to have to purchase the more shares if they want to keep their existing percentage ownership. So that does, provide a burden on the existing shareholders to that extent as well, that they have to, purchase more shares. Institutional investors will be discouraged from buying into corporations that have an aggressive defensive strategy. So large investors might see that as a bad thing, because from if you take a step back and look at this from a distance, you would think that a hostile takeover, just in market terms, might not be the worst thing, because if the hostile takeover allows the company to be more efficient, then maybe that's a good thing from a market perspective, from a long-term market perspective. And obviously the larger investors are the people that might be the ones that are looking into those kind of changes, being the hostile takeover types of individuals that might be saying, hey, is there something this company has that they could be better at, possibly, if we were to change management or change the direction and whatnot. So that could discourage that kind of investment. The ineffective managers may end up staying in place through the poison pills. So clearly the poison pills are there to try to stop, the hostile takeover from taking place. And there could be different ways that could be set up. But if you're in a situation where, just from an economic standpoint and from the shares or the value of the company kind of standpoint, if you're in a situation that the hostile takeover is something that could happen due to the fact of the management not being effective, and you got people that are basically saying, hey, if we were to take over the company, replace management, and basically take a new direction with it, we could be more profitable. Again, just from an economic standpoint, you could think that that would be good from an economic standpoint, right? To if you can make it more efficient, just from just purely economic standpoint, not in a personal position in there, then that might be a good thing. So if your poison pill is actually resulting in having management that's less efficient, then that's going to be less beneficial to the shareholders and less good generally for the economy as a whole. Although, of course, the people that are currently doing what they're doing there would benefit possibly from that situation.